Here are 3 reasons why to subscribe to Fringe Financials on YouTube. Number 1, it is free, which is the best price that you can pay for this kind of content. 2, I am completely transparent with all of my investments. And number 3, I have a variety of educational videos every single week. Now let's get on with the video. What is up, YouTube, and welcome back to another Fringe Financials video. And in today's video, we are already looking at 2024 stock market predictions, and the year isn't even over yet because we're all getting ready for the new year already. If you're excited for today's video, make sure that you smash the thumbs up button, subscribe to the channel, and turn on the bell notifications for all future uploads. And leave any comments you have down below of anything you'd like to know more about, anything you have questions about, whatever it is that's on your mind, leave it down below, and I'll make sure to respond to each and every single comment that you will write. Now, this article came out in Friday, December 1st, which was yesterday when I'm recording this video. And they already are doing, the big corporations are doing a prediction of 2024 markets, and it's really mixed. So we're going to dive into it. We're going to talk about it. We're going to look at some data, and we're going to hopefully just see, who might have a good point. Maybe somebody has a good point. Maybe they don't have a good point. And then we'll kind of go from there. I always like, and again, Business Insider has put together a complete rundown of the top Wall Street forecasts for the stock market of 2024. The first one is BCA Research, right? And they're being bearish as of next year of the S&P 500. And they're being super bearish because right now it's trading at about 4,600, I think. I see, 4,600. And they're predicting it to come down to 3,300, which is insane. So the S&P 500 could experience its worst crash since 2008. Don't love that because that's when we had the recession. 2008 with the banking, with the housing market situation and all that stuff like that, which is awful for people. Honestly, I don't really remember much of it because I was, I think, like 13, so I was in high school, so I don't really remember much about that, obviously. So this could be its worst crash since 2008 next year as a recession kicks off, according to the 2024 outlook of BCA Research. Great, love that. So a recession kicks off. It makes it sound like it's like a hype. Like, get hyped for a recession, guys, because that's what they're covering here. A recession in the U.S. and Euro area was delayed this year, but not avoided. Developed markets remain on a recessionary path unless monetary policy eases very significantly. As such, the risk-reward balance is quite unfavorable for stocks. The stock market could avoid such a steep drawdown next year if the Federal Reserve swiftly cuts interest rates, but BCA Research isn't holding its breath, and they don't expect inflation to fall quickly. We remain in this disinflationary camp, but expect that inflation will not slow quickly enough for the Fed and the ECB, which is the European Central Bank, to cut rates in time to prevent a significant rise in unemployment. Unless a recession occurs imminently or inflation completely collapses, the Fed is unlikely to cut rates before next summer, which again is true because right now they're talking about having a cut happening in the summertime, as you can tell by this chart right here, which I've referenced in a previous video. It's back again, same chart. They're pricing in, looking at May and June. So they are thinking of a possible recession for next year, which could definitely put the S&P 500 between a range, as they predict, of 3,300 and 3,700, right? And again, the recession really happens when we have a really uptick in unemployment. And when people have a lot of unemployment, people start to hold their money. The market starts to fall quick because everyone starts to withdraw their money. They start to pull money from banks, start to pull money into their savings, start to try to, they like freeze up because they don't have income coming in. So they freeze up to try to hold all their money possible. So if you have a significant uptick in unemployment very, very fast, again, just like the Great Depression back in the 1920s and 30, or 1920, whatever it was, I remember the exact day. But again, since a lot of people were laid off and unemployed, they started pulling the money out of the banks, and then it kind of shut the economy down and went to that Great Depression. And they're fearing the same thing, whereas if you have a huge rise in unemployment, then people are starting to panic. They're going to pull their money. They're going to try to keep it because you're going to need the money for food, for a roof over your head, for clothes, for everything else. And again, pulling the money out is going to deflate everything, but it might deflate it too quickly to a point where it might put us into a recession. So they're freaking out about that. So that is their first prediction. A great way to start off the video is to talk about that kind of a prediction. Now, JP Morgan is also bearish on the S&P 500, but definitely not as bearish as the BCA Research, which was 3,300. They're predicting a little bit of about a $400 down trend or $400 decrease of next year for 2024. JP Morgan says high equity valuations, high interest rates, a weakening consumer, rising geopolitical risks, and a potential recession give it little comment that stocks will move higher. Again, potential recession is still here in terms of some of these corporations in Wall Street. So we're not out of the recession waters just yet. We are still very much a possibility of that being the case starting off 2024. High equity valuations is definitely a thing to think about. Again, that basically is focusing on stocks that are very overvalued. You know, you can look at some of these stocks that are trading at very, very high price to earnings ratios, or a PE ratio, they call it. And some of these companies are trading at a very, very high value. The S&P 500 is also trading at a higher PE than average, which again can be a little bit concerning because, you know, usually again, it's the average is whatever. I think the average is like 17 or 18, or after like 22. So, you know, history repeats itself as it comes back down to 17, aka more selling loss can happen. So definitely high equity valuations like in stocks and in crypto and all those kind of things could definitely play into a fact that they can only go high for so long. Higher interest rates, which I talked about, we still have. A weakening consumer, again, talk about inflation. So people aren't going to be able to buy as much money. A rising geopolitical risks. Again, things went on overseas, you know, in the Middle East, over in the Ukraine and Russia. You know, there's still tensions there and everything else. So those are all factors playing into here. We expect a more challenging macro backdrop for stocks next year with softening consumer trend at a time when investor positioning and sentiment have mostly reversed. Again, the more uncertainty there is in the market that all these things might play out, the more fear that can happen in the market. The more fear that happens in the market, the more that people sell off, the more selling off, the chart down, and everything else. The snowball effect, essentially. Equities are now richly valued with volatility near the historic low, while geopolitical and political risks remain elevated, right? Again, like I said before, things happening over the Middle East, or happening over the Ukraine, they're not settled. There's still tensions all over the place, and, you know, if something else comes up, maybe more things could happen as a result of it. So we don't really quite know. And again, it's that uncertainty that causes the fear. And it's that fear that's going to drive the market. So we're not out of the waters yet, according to JP Morgan. Again, this is not my opinion. This is what JP Morgan is stating on this article here. Morgan Stanley, another big, you know, person on Wall Street, is neutral with the price of 500. So basically, not going to do anything the entire year, which would be, you know, kind of be lame, right? I mean, usually if it goes down, you have a nice buy the dip opportunity. If it goes up, you're making money. Flat is like nothing really happens to it much. So, but consistent, but see as some pockets of stock market performing better than the others. The extremely narrow leadership of the mega cap tech stocks is likely to continue early next year, but eventually break down according to the firm. So again, tech can only rally so much before we have any kind of pullback. Your market can't just go straight up in a straight line and there's no pullback. That is not a healthy market. So with NVIDIA being up 220% on the year, that is very, very unlikely going to happen again next year. And that's probably going to be due for a significant pullback at some point. Maybe it rallies into the new year to start the year off on a good note, and it's like, oh my God, great. And then maybe it just comes back down because you're like, you know what, I'm taking profits. This thing cannot keep running up as much as it does. So you might see a breakdown of those big tech companies. The question for investors at this stage is whether the leaders can drag the laggards up to their level of performance, or the laggards will eventually overwhelm the leaders' ability to keep delivering in this challenging macro environment. We think these dynamics are likely to persist into early 2024 before a sustainable earnings recovery takes hold. We ultimately see plus 7% earnings growth next year. So again, I think at some point, if the market's pricing in a higher earnings growth of next year, and they're predicting 7%, which is a little bit less than that, I think what's the price right now is, I think, 12%, I think is what some economists are saying. So if you're going to have 12% earnings growth next year, and they're thinking of 7%, again, when they miss out on those earnings, again, stocks tend to drop, stocks tend to lose value. So just something to keep in mind about, again, this is another opinion of someone that works on Wall Street, Morgan Stanley, which has, it's an investment banker and everything else. Morgan Stanley recommended investors avoid the high-priced tech stocks, Google, Microsoft, Amazon, NVIDIA, Tesla, those kind of ones. Instead, focus on defensive growth stocks typically found in healthcare, utilities, consumer staple sectors, as well as late cycle cyclical stocks typically found in the industries and energy sectors, aka dividend stocks, because those are your safe haven stocks for next year, right? Healthcare, utilities, consumer staples, those are all companies that usually are ones that pay dividends. So stay away from the growth next year is what they're saying, and probably put more money into the dividend saver stocks. That's what they're saying. Goldman Sachs, again, neutral price target at 4,700. Maybe a little bit of uptick in it. Let's see, talk about anything else here. As higher for longer interest rates mark valuation expansion from here difficult to justify, our market forecasts are broadly in line with earnings growth. On a weighted basis, we expect 8% price returns, 10% total returns for global equities, so 10% returns. I said 12, I guess it was a little off. Corporate earnings should also remain solid next year, providing a buoy to stock prices as long as the recession is averted. Again, that keyword recession is just coming back into everybody's words and vocabulary. It's the everyday word now is recession. In the absence of a recession, corporate earnings rarely fall. Nevertheless, the lack of strong profit growth and high starting valuations and low equity risk premium leaves are an unexcited outlook overall on risk-adjusted basis relative to cash. So again, neutral. So a couple that are neutral, a couple that are bearish. Bank of America, bullish. Really want the high market next year, 5,000, rounds at 4,600. Bank of America is bullish in the stock market for 2024 because of how much progress the Federal Reserve has made towards tightening its monetary policy following more than a year of aggressive interest rate hikes and the ongoing reduction of its balance sheet. AKA, Bank of America saying the Fed has done such a phenomenal job of controlling this economy in a little over a year. We are in great hands with the Fed Reserve, with Jay Powell, with everybody in the economy. We're doing great. We're going to kill it next year, basically. So that's basically what I'm getting for anyways. So we're bullish not because we said the Fed did cut, but because of what the Fed has accomplished. Just hyping up Jay Powell. Love it. It also helps that investors remain laser focused on a potential economic recession. God, that is in every single Wall Street analyst statements right here on this article. Potential economic recession, potential recession, looming recession, all that crazy stuff. It's here, and it could cause fear in the market. We are past maximum macro uncertainty. The market has absorbed significant geopolitical shocks already. And the good news is we're talking about the bad news. Basically, we've already gone through geopolitical shocks. And we've done pretty okay with these wars going on overseas and everything else. So, we've already gone through it. So we're nothing but up from here. We're already at the lowest low. We're going up from there. That's what Bank of America is basically saying. Then you have World Bank of Canada, bullish, same thing, price 5,000. Stock market strong 9% rally. May have pulled forward some of the 2024 potential gains, but there's still further upside ahead according to their outlook. Main driver could be a continued decline in the inflation rate, aka rate cuts, as we talked before. Implicit in our valuation models is the idea that continued moderation in inflation can do most of the heavy lifting out of the PE multiple. Again, that's how you talk about valuation of stocks. And the higher the PE, the higher you're paying for a stock that's got more growth into it. Something our analysis suggests happened back in the 1970s. The Canadian bank added that while the 2024 presidential election, this is the first people that have brought this up, the 2024 presidential election could add uncertainty to the market. S&P saw an average of a gain of around 7.5% in presidential election years. And that is also interesting. Again, people always tend to look in the market as history repeating itself. You look at the past to predict the future, and then you react based on what's happening. So that's kind of what World Bank of Canada is bringing into play. And they're the first ones to talk to the election, because that is true. Our presidential election for the U.S. is next year, 2024 in November. What this stat tells us is that any given presidential election year is a source of uncertainty for the U.S. equity market, given all of the unusual aspects from the contest. It seems like it. Okay. We have Federated Hearns, never heard of them, bullish, price 35,000. Assuming that's still out here, we think the stocks are going to go grand higher. They've gone from 4,100 to 4,500. Yeah, okay. We think the trend that's a trend that got legs. Great. Milano talked about his bullishness to his belief that the Federal Reserve is on hiking interest rates, which is again priced in, as you can tell from that rate hike tool. Given that inflation has cooled considerably from its peak. Again, I guess get off the inflation data. The bond market's done the heavy lifting for the Fed since the last Fed rate hike in July. Again, the bond market, when stocks go down, your bonds go up, and they kind of balance out each other that way in that aspect. So since the bond market rates were so high, people are flying into those ones. And again, at some point, it kind of helps pull the money out of the market and kind of cool it off a little bit. That gives the Fed the luxury, in my view, to step away and say, you know what? We don't have to hike anymore. In my view. He's Joel Dow, basically. You just sit down the silence for the next year and allow the gradual slowing of inflation to occur. Then you have Deutsche Bank, bullish, price target 5,100.
U.S. economy is approaching a soft landing as inflation pulls and GDP growth remains solid, and that's a great to note. That is true. GDP continues to grow, which is good because it shows you have a strong economy. And even if an economic recession does materialize, and even if an economic recession does materialize in 2024, it shouldn't impact stock prices dramatically because most investors are anticipating it. So basically, they're saying that if we have a recession, then it's already priced in. And if we don't have a recession, this thing's going to take off because people are already expecting the worst. And if you expect the worst and it doesn't happen, you get the best. So, that's what they're saying. It seems like the bank expects S&P to rise about 10%. And if the economy dodges a recession, the gains could nearly double. See, that's what I just said, right? I didn't read that part. I didn't read ahead, but it's okay. Love that. BMO, same thing. Price target for 5100. Stock market will deliver another great year of solid gains. Falling inflation, falling interest rates, strong job market, and rising corporate earnings are tailwinds that will drive further upside in the stock market next year, according to BMO. U.S. stock market performance and fundamentals in 2023 followed the script in our view to lay the foundation for what we continue to believe will be the path of normalcy for earnings growth, valuation trends, and price performance that is likely to unfold over the next 3 to 5 years. Okay, this has been a long video, so I apologize. Hopefully you guys understand what's on this video here. But again, as you can see, there's two sides to it. Technically, three sides. The bearish case, where recession, fear, politics, unemployment, crash of the market, everybody freaks out. Neutral, those things can happen. We also could have it not happen, but we also have other things going on in the world around us that could also keep it flat and stable. So some positives, some negatives will cancel each other out. And we have bullish, where it's more of just like, we've already dealt with the worst. We're going nothing but up from here. And you better get on the rocket and buy some money and hope for the best. That's the different views of most right now. So, again, as I say in other videos, only time will tell. Again, not a financial advisor, just reading the article and taking my perspective on it. As you will see, though, the one common thing that's been talked about, potential of a recession. So just keep that idea in mind, that these major Wall Street companies, these major Wall Street corporations are all talking, except for like one, I think, are all focusing on a potential recession. Is there going to be one? Is there not going to be one? Only time will tell. But thank you so much for watching today's video. Again, if you made it this far in this long video, make sure that you are smashing the thumbs up button, subscribe to the channel if you have not already done so, and turn on the bell notifications. Hope you guys have a great rest of your day. Hope you make money in the market, and I will see you guys in the next video.